Today, we will talk about the cost of debt and its formulas. This is a fundamental concept in finance that can help companies and individuals understand the cost of borrowing money. The cost of debt is the total interest expense owed on a debt. Put simply, the cost of debt is the effective interest rate or the total amount of interest that a company or individual owes on any liabilities, such as bonds and loans. This expense can refer to either the before-tax or after-tax cost of debt. The degree of the cost of debt depends entirely on the borrower's creditworthiness, so higher costs mean the borrower is considered risky. Debt is any money owed by one entity to another and is rather common for companies and individuals. For corporations, debt is one part of their capital structures, which also includes equity. The cost of debt measure is helpful in understanding the overall rate being paid by a company to use these types of debt financing. It can also give investors an idea of the company's risk level compared to others because riskier companies generally have a higher cost of debt. There are a couple of different ways to calculate a company's cost of debt, depending on the information available. One way to calculate the cost of debt is by using the formula for the after-tax cost of debt. The risk-free rate of return is the theoretical rate of return of an investment with zero risk, most commonly associated with U.S. Treasury bonds. A credit spread is a difference in yield between a U.S. Treasury bond and another debt security of the same maturity but different credit quality. This formula is useful because it takes into account fluctuations in the economy, as well as company-specific debt usage and credit rating. If the company has more debt or a low credit rating, then its credit spread will be higher. For example, say the risk-free rate of return is 1.5% and the company's credit spread is 3%. Its pre-tax cost of debt is 4.5%. If its tax rate is 30%, then the after-tax cost of debt is 3.15%. This is calculated by using the risk-free rate of return and adding the credit spread to get the pre-tax cost of debt, then multiplying it by to get the after-tax cost of debt. Here are 4 key takeaways. 1. The cost of debt is the effective rate that a company pays on its debt, such as bonds and loans. 2. The key difference between the pre-tax cost of debt and the after-tax cost of debt is the fact that interest expense is tax-deductible. 3. Debt is one part of a company's capital structure, with the other being equity. 4. Calculating the cost of debt involves finding the average interest paid on all of a company's debts. Hope this would help. Thanks for watching.